The real mandate is keep confidence in the US dollar. Why? So the US Treasury can keep borrowing. Why? Because Congress is not going to stop spending. And so that's really what's going on there. And so, but and that's their job. And the reality is, you ask anybody in the world, if I hand you $100,000 of US dollars or $100,000 of Bitcoin, what are you going to take? 98% of the people are just going to take dollars, because they're like, oh no, Bitcoin, I don't know. It's for criminals. I don't understand it. Maybe it'll go down 10% tomorrow. I can't trust it. It's just not there yet. It's going to take some time.
Lavish begins by reflecting on Bitcoin's earlier days. Back then, stablecoins barely existed, and traders commonly held Bitcoin directly on exchanges as their base trading currency. People would trade altcoins against Bitcoin pairs, meaning Bitcoin itself functioned as the reserve asset of the crypto ecosystem. But today, that use case has largely disappeared. Stablecoins like USDT and USDC now dominate exchange liquidity, meaning Bitcoin is no longer primarily being used as transactional trading money inside crypto markets. However, Lavish argues this does not weaken Bitcoin's long-term value proposition. Instead, he believes Bitcoin is evolving into something much bigger: digital gold. According to him, Bitcoin's role is no longer centered on everyday payments. Instead, it is increasingly being viewed as a store of value, an asset designed to preserve wealth over time in a world where fiat currencies continuously lose purchasing power. This distinction is important. For years, critics argued that Bitcoin failed because it wasn't widely used for coffee purchases or daily commerce. But Lavish says Bitcoin's true destination may never have been small retail transactions in the first place. Just as gold is rarely used for day-to-day payments today, Bitcoin may ultimately function more as a global reserve asset than a spending currency.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
I wasn't around for the early days of Bitcoin, when people were on exchanges and they kept their money in Bitcoin because there weren't stable coins around, and they used Bitcoin as the pair to trade other stuff. It was literally, they kept their money in Bitcoin and then traded around other stuff against it. So there was that use case that was pretty big on exchanges, but that's kind of pretty much gone away already. And so I don't think that really impacts on that side. If she's thinking, of course, Bitcoin money, it's going to reduce the use case of Bitcoin as money. Well, I don't really feel like that's the case. I mean, think about it this way. I think about it as Bitcoin is digital gold, right? At this point, we're talking about it as digital gold. We got to get it out of the first. You've got to get that great understanding that I talked about earlier, which is having institutional investors and retail investors all across the board have a firm understanding of what Bitcoin actually is, and that it's a store of value rather than just a speculative asset, which is what it's been for all this time, because of, just because of all of the narratives around it that just keep getting passed around, and the misunderstanding that keeps getting pushed by mainstream media. But that's number one. And so we start there. If you're going to be using gold as a currency, then you've got to be able to have it divisible in a way that makes sense. And of course, Bitcoin can overcome that. But you're talking about here a hyper Bitcoinization world where Bitcoin becomes the base currency and everything's priced against it instead of dollars, basically. But again, this feeds exactly to what I was saying. I think it takes a very long time for Bitcoin to become base currency of the world. I love Jeff Booth, and I've had long conversations with him about this. I think it eventually happens, but I just don't think it's going to happen in the next 5 years. I think it's going to, the go back to the first principles of the Fed, and we haven't even talked about the Fed yet, but the Fed is supposedly has two mandates. Two mandates are stable pricing, which is 2% inflation, constant 2% inflation. How they came up with that 2% is There's absolutely no real reason behind it. Some people say, well, it's the expansion of the gold supply, or it's, it was what Australia came up with. And honestly, the bottom line is, Rizzo, what I truly believe is it's what they can get away with. They can chip away 2% every single year and people don't miss it. When it starts getting on the 5, 6, 7, 8, 9%, people get pissed off, as we saw in the last few years. So stable pricing, keep confidence that inflation will not get out of control. That's number one. Number two is they have to keep full employment, whatever that is. There's no real formula for that. It's like, well, I mean, how many people are participating? How many people are like, I don't know. It's like feels full. I don't know. But those are two supposed mandates. The real mandate is keep confidence in the US dollar. Why? So the US Treasury can keep borrowing. Why? Because Congress is not going to stop spending. And so that's really what's going on there. And so, but and that's their job. And the reality is, you ask anybody in the world, if I hand you $100,000 of US dollars or $100,000 of Bitcoin, what are you going to take? 98% of the people are just going to take dollars because they're like, oh no, Bitcoin, I don't know. It's for criminals. I don't understand it. Maybe it'll go down 10% tomorrow. I can't trust it. It's just not there yet. It's going to take some time. I mean, you were still at the beginning stages of it. So when you hear somebody like Cathie Wood talk about this, like, it's kind of what's your vision in the next 10 years? And my vision does not include hyper Bitcoinization in the next 5 or 10 years. I think it's going to take a long time for the US dollar to lose enough confidence that everything starts getting priced in Bitcoin. Now, it could happen off of what Larry calls the big print. We have another massive crisis. We have another, I don't think people will stand for another lockdown, but you have some sort of major crisis, major credit crisis that causes the world to print again, not just the Fed, but the central bank, or the European central bank, the Australian central bank, the Canadian central bank, like everybody, Chinese central bank, everybody has to print. And then suddenly every single currency is just inflating so quickly that people are losing confidence in it. That's how you get to, that world. But I think it's going to take a while again, and it's going to take a massive print, not $5 trillion, but like $25, $50 trillion. And then people will sit up and take notice that these things are just collapsing. They're useless. They're worthless. Well, I mean, that we had this 4-year cycle mentality that just played out. Like, it was almost like self-fulfilling prophecy. We had that major deleveraging event in October that who knows what was really behind it. But on the backside of that, I mean, you had a lot of OG selling going into that. And, 1 million coins being sold off from old wallets going into the all-time high of 125,000. I think, Rizzo, I think there were a lot of early adopters of Bitcoin that, God bless them, they held on to this thing for so long. They held on from $100 or $1,000 all the way up to $100,000. Like, when it gets to 100 grand, I am selling a quarter, half my stack. I'm going to go monetize my lifestyle. Not sit in US dollars, but buy the house I want, maybe the boat, or, the land I want, whatever it is. And so it kind of self-fulfilled. And then once that happened and we started getting that sell-off, we ran right into that bear market. Like, we just went from 125, that just systematically just hammered all the way down to $60,000, 62 or whatever what the exact low was, depending on the exchange. But, so it's kind of played out to, I feel like if the world stabilizes here and we get through this Iran conflict and we stabilize the Strait of Hormuz, and we don't have an AI driven bubble that blows up the stock market. God knows that we're getting close, right? But if we can stabilize here and not have some sort of event, I think we've found bottom already. That said, we have a 20, 30, 40% sell-off in the regular stock market or tech stocks. it's going to take Bitcoin with it. We're going to have a correlation to one event, everything will sell off with it. But the backside of that is what we just talked about: print money, make sure that the debt-driven system continues, and all these things. Gold will start, then Bitcoin will follow, and it'll rip higher again on the other side of that. But what do we need to restore confidence in Bitcoin? Well, I think we're just grinding sideways here, and people, we had, unfortunately, a lot of FOMO at the $100,000 level. People finally said, "Oh my God, it's $100,000. I got to get some before it gets to $1 million." And of course, a lot of people have lost money, and so there's big pockets of holders at $85,000, $90,000, $100,000 that they just bought late. And I think you got to get through that first. Got to get that goat through the boa, to put it, and then we'll get to the other side of confidence. But really, the truth is, we need the people to broadly understand Bitcoin to get into that full, like, when we talk about a super cycle, we're talking about people understanding Bitcoin more than just it's this speculative asset that's been around for a long time. Oh, it's dead, or that it's for criminals. Get through that. And as these institutions are buying, it's the craziest thing, because all this time you've had retail able to front run institutions in Bitcoin. They've been able to buy this thing before institutions for years and years and years and years and years. And then all of a sudden ETFs come out, institutions are involved. Now they can buy it on the market. They can buy the ETF, which is the underlying Bitcoin that they're going to force those ETF providers to buy. And now you have pension funds, family funds, small endowments, small foundations that are buying Bitcoin through these ETFs, and the institutions are getting on board. But remember, who are the institutions buying for? They're buying for their underlying liabilities. Who are those liabilities? By and large, they're people. Endowments, their liabilities have to do with the institutions that they're involved with. But pension funds, they're the underlying people. That's the biggest group of institutions right there. And so when people start understanding that, oh man, my endowment has been investing in Bitcoin for years, maybe there is something to this thing, and I should be buying some. It's hard for us to understand in our Bitcoin bubble here. We're on Twitter every day with people who understand it all day long. And we're talking to people on podcasts. We're listening to podcasts. We're interacting with people like Michael Saylor, or, with Jeff Booth, or with the OGs who really understand it. And you when you go out into the regular world and you ask your your cashier at the register, do you own Bitcoin? They're like, no, that stuff's crazy. I can't buy that. Are you on Polymarket? Oh yeah, I'm on Polymarket every day. So, it's like people just still don't get it. So they treat it as this risk asset that's already played out, versus a Polymarket where they can bet $100 on, whether Trump says a certain word today. It's like they'll bet on anything, but they still consider it as part of that betting sphere, yet it's played out. So once they truly do get to an understanding that no, this is where you have a stable asset that's going to just keep swallowing unstable assets into the future, then it's that tide turns. But again, I think it's a long time. Price predictions? I think Bitcoin's going to be much higher at the end of the year this year. I think we're going to get through this period. Again, first principles are that this administration wants to have peace going into the summer, because we've got an election coming up. He doesn't want to lose the election in the midterms. So he wants to have stable pricing, gas prices down, stock market, hitting on all cylinders, and Bitcoin will benefit from all of that. And so that's my expectation for the end of this year. And then once we regain 100,000, I think the march to 125 is pretty expeditious, and then we bump around there for a little bit. But once we get through 125,000, It's blue skies until the next mental price point. A little bit of 150, a little bit of 200, 250. Who knows? You don't need $1 trillion to pour into Bitcoin to double the price. You need there to be fewer sellers at certain prices for it to just move higher, and people willing to buy it at that higher price in smaller increments. That's just the reality of markets. And so we'll watch it play out in real time here, but I'm highly confident that we are going to be much higher in the next few years.
This is where Bitcoin enters the picture. Unlike fiat currencies, Bitcoin has a fixed supply. Only 21 million Bitcoin will ever exist. So while governments can continuously print dollars, euros, yen, or pounds, Bitcoin remains mathematically scarce. Lavish believes this scarcity becomes increasingly attractive during periods of aggressive money printing. He argues that every major financial crisis eventually leads central banks back to the same solution: print more money to stabilize markets. We saw this after the 2008 financial crisis, the COVID lockdown period, banking stress events, liquidity crises, and Lavish believes future crises will likely trigger even larger rounds of monetary expansion. He even references the possibility of another big print event, potentially involving tens of trillions of dollars globally, which could dramatically weaken confidence in fiat currencies. In that environment, Bitcoin could accelerate rapidly as investors search for scarce, non-sovereign assets.
I mean, look, we've talked about this for so long, right? Just the landscape of the fiat debt-based system that we live in. It just continues to roll on. We're expanding the money supply at somewhere around 7% annually for many decades now, and it's just we're in this what I call, and what many people call, a debt spiral. And what that means is we're spending more than we're able to take in revenue. And there's a lot of different reasons for that. There's a lot of people fight over solutions for it, and what it really comes down to is ultimately it's what I call the 4-door problem. You've got 4 doors you can choose from. If you're a fiat based country that issues debt in your own currency, and you're running deficits like we are year after year after year that are just growing. We're over $2 trillion deficit right now. And as you do that, you have to borrow more. And as you borrow more, interest rates, ultimately go higher because investors demand to be paid for that inflation risk, because they know that you're going to debase the currency. And so let's just break it down for your listeners. Many of your listeners probably have heard me say this quite a bit, so we'll run through it really quickly. But the bottom line is, when you look at a situation like this, and you've got a country that's running such high deficits, and the deficits are leading to growth of the debt, the overall debt, which the U.S. is now at $39 trillion. That debt doubles every year, or every 10 years. So 2035, 2036, we're looking at $80 trillion of debt that we're sitting on. And that doesn't include unfunded liabilities, which is a whole nother problem. And I wrote about that this weekend in my newsletter, if people want to dig into that a little bit further. But the bottom line is, you have a few choices. Door number one is just to raise taxes. You just raise the amount of revenue that you're going to take in, and that closes that gap. But the problem with that is, as New York is finding out pretty quickly, super high net worth and wealthy individuals don't have to stay in your district or in your domain. They could just leave. That's number one. Number two, and so you may get a one-time tax out of them, and that's it, and then they're gone. Number two is, you're really raising taxes on in the United States. Really, the engine of our economy is both the stock market and small companies. Really, you've got the Mag 7 that are massive, but if you think about it, you've got all these companies, including the Mag 7s. If you raise taxes on them, what happens? Well, they, instead of reinvesting into their productive product lines, expanding on them, investing in research and development, hiring people, expanding on different products. Instead, they just hand that money over to the government, who wastes it. And so what happens is you get this peak of taxes with that productivity, and then the productivity starts to decline because of the taxes. And it's the Laffer curve. Who was an economist who was on Ronald Reagan's. He was in his cabinet. It's worse though, because you end up having higher taxes on lower productivity. Now your productivity is declining. So it really is not a good plan to just keep raising taxes. The second thing you do is cut spending, which obviously austerity is it's not something that either politician or political party wants to do. They try to trick each other to do it, but nobody wants to lower their spending on their constituents. They've got a lot of the massive amount of lawyers that they spend most of their time in there just politicking for lobbying for their interest groups. And so they're not going to stop spending. Every single year, every single time we come up with the debt limit, doesn't matter which party we're under, they're going to raise the debt limit. They're going to keep spending. So that's just, they fight about it. They accuse each other of it, but then they just keep doing it. So that's really not going to happen. The third thing you could do is it's pretty dramatic, and it hasn't happened in the U.S. in a full default, but you could just default on your debt. You could just say, we're not going to pay our debt down. We're just going to we're going to take a haircut on it. You're going to give you pennies on the dollar for the debt that we owe you, and then we're going to reset. Well, you wouldn't do that, because that puts you in a pretty precarious position of trying to issue debt in the future with dollars that people can't trust that they're going to get back. So, no, and if you're a country that issues debt in your own currency, you wouldn't do that. You would do what is, we've had technical defaults before. So in the comments, people say we have defaulted. We have, where we didn't raise the debt ceiling early enough or quickly enough, and back when we literally sent out checks to banks and people for their interest payments on treasuries, and they technically defaulted for a day or two, but they make it up in interest and all that. So it's that we have done it, but the reality is that they're not going to hard default. It's just not going to happen. And then the fourth door is the obvious one, which we've been playing this playbook ad nauseum, and it's just debase the currency. And what do I mean by that? Well, the way the system is built, we're built on debt and borrowing. And so banks create, they create credit, they create loans, and then they have assets basically put on their books by the Fed it just expands the money supply. The Fed prints money in order to buy bonds, in order to keep the bond market going and liquid. It's doing it right now. It did it in 2019. It did it in 2020. It did it after the great financial crisis. They just print money. In 2021 to 2023, they printed $5 trillion basically, and monetized the debt. And so what they did is just poured money into the system. And what happened? Well, you've had massive inflation ever since the lockdowns from COVID. And so people understand that. They understand the inflation. They don't really, the reasons for it, your everyday person, not your Bitcoiner, but your everyday person's confused by it. They think it's supply chains. They think it's Trump. They think it's tariffs. They think it's, whatever it may be, shortage of goods. It's not that. It's just that they keep printing more money. It's like you throw a bunch of money on a monopoly table, everything on the table is going to be more expensive. That's just what it is. And so it's the same thing. And so that's kind of where we're at. And well, the issue here is that you're seeing bond buyers, even the ones who have to buy debt, the ones who are like pension funds and endowments, and they have strict guidelines that they must be buying certain amounts of debt in their portfolios. They're looking for better prices, because they know that they've got to beat the hurdle rate of actual debasement, not just CPI, which is a manufactured number. by the Bureau of Labor Services, but they need to beat what the actual inflation is, which is it's much more closely tied to the expansion of the money supply. And so to do that, they've got to get what's called a real return on interest, meaning they've got to make a yield on those bonds that's higher than that debasement, than that expansion of the money supply. So you're talking about, if it's really 7%, then their blended returns on their portfolios has to beat that. So, and they understand that. And so back in the 80s, what you had is you had this, what they called the bond vigilantes, who just forced the Fed's hand, which said, we're not going to buy this debt until we get a return that's much higher than you're offering. And so they just kept backing off. And so so that's why when you hear all this noise and all this all the fighting about the Fed and they should be lowering rates and whatever, if the Fed lowers rates here today, the long end of the curve, meaning the 10-year, the 20-year, the 30-year bonds, those yields are going to go up, meaning the bonds will go down in price and the return on those bonds will go higher, because they're going to demand higher returns for that debasement. And you're seeing this happen in real time right now in the UK. Their gilts, the UK gilts, are trading, over 0.5% higher than when we had that crisis a few years ago.
Lavish also discusses Bitcoin's recent price behavior. He believes many early Bitcoin holders who accumulated coins at extremely low prices eventually decided to sell portions of their holdings once Bitcoin crossed major psychological milestones like $100,000. That wave of profit-taking contributed to sharp corrections and market fear. At the same time, many retail investors entered the market late through FOMO, fear of missing out, buying near all-time highs before experiencing losses during pullbacks. Lavish believes Bitcoin now needs time to rebuild confidence and absorb those sellers before the next major breakout phase begins. However, he remains bullish long-term. He argues that if global markets stabilize and major geopolitical crises ease, Bitcoin could regain momentum quickly. And once Bitcoin decisively surpasses previous highs, price discovery could accelerate dramatically because markets move based on supply and demand, not simply the total amount of money entering the system.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.